If you want to save thousands on your taxes legally just by running your business the right way, then stay tuned. In this video, we're breaking down the qualified business income deduction, what it is, who qualifies, and how to calculate your 20% deduction using the new 2025 rules. Let's jump in. So, what is this QBI deduction? The Qualified Business Income Deduction, created by the Tax Cuts and Jobs Act, allows owners of pass-through entities to deduct up to 20% of their qualified business income on their personal tax return. This is a below-the-line deduction, meaning it does not reduce your business income, but it does reduce your taxable income. That's all good, but who qualifies? You may qualify if you have income from sole proprietorships, an LLC if you file a Schedule C, partnerships, S corporations, some real estate rental activities if you're considered a trade or business, and certain trusts and estates. You do not qualify for QBI if your income is from C corporations, W 2 wages, investment income like interest, dividends, capital gains, and guaranteed payments to partners. All right, now that you know how to qualify, let's talk about how to compute the QBI deduction. Step 1, determine your qualified business income. Qualified business income is generally net income from the business after taxes, but before self employment taxes, owner's draws or distributions, capital gains and losses, non trade related income such as interest and dividends. For example, if your Schedule C business had 120,000 in revenue and 20,000 in expenses, your QBI income is $100,000. Then step 2, apply the 20% deduction. For most taxpayers below the income threshold, the QBI deduction is simple. 20% times that QBI income that we just calculated. So from that example, the QBI was $100,000. So $100,000 times 20% equals $20,000. That's your tentative QBI deduction. Of course, there is a caveat. There are income limits and phase outs. If your taxable income before the QBI deduction exceeds certain thresholds, limitations apply. If you're below the threshold, you get the full 20% deduction regardless of the industry. If you're above the threshold, two potential limits apply. First up is the W 2 wage and capital limitation. Your deduction is limited to the greater of 50% of W 2 wages paid by the business or 25% of W 2 wages plus 2.5% of unadjusted basis in qualified property. The second limitation is the specified service trade or business phase out, or SSTB. If your business is an SSTB, think doctors, lawyers, accountants, consultants, and the like. The deduction begins to phase out once your income exceeds the threshold and fully phases out above 260,000 for single filers and 520,000 if you're married filing jointly. But you want to keep the full deduction, right? Well, here's how. Switch to an S corporation and pay yourself W 2 wages. Use aggregation if you own multiple businesses. Or keep your taxable income below the phase out. Now, if you're a married filer, you can shift income with your spouse to help keep you below that threshold. And if you own rental properties, you can elect the IRS safe harbor, which can allow you to treat the activity as a trade or business, thus qualifying you for QBI. How do you claim the QBI deduction? That's simple. Use Form 8995 if you're under the threshold or 8995A if you're over the threshold. This deduction reduces your taxable income, and you want to apply it to each qualified business separately unless you choose aggregation. The QBI deduction is one of the most powerful tools small business owners have to save on taxes. If you need help calculating it, download our free QBI calculator in the description. Don't forget to like, comment, and subscribe for more tax-free strategy tips. Thanks for watching. See you next time at the Tax Free Strategy.